All right, Chuck, welcome back to the 10-second interview show. It's been a little while since we've done one. We only want to do it, like we've always said, when it's important. And given what's going on in markets and with the administration and with tariffs and with tech and with all sorts of, fears running rampant, it's important. So here we are. We're back at it. 10-second interview show. Just a refresher because it's been a few months. I ask you a question. I ask you 5 questions. You have 10 seconds to answer each question. Right? It's a TikTok world. Nobody's got time for a long answer. We are the epitome of TikTok dudes. Right? When you think of TikTok dudes, you think of us. Okay. All right. So Chuck, Nate, let's throw up the clock if you could. 10 seconds or less, Chuck. Tariffs are running wild in the form of we are putting tariffs on the goods of Mexico, Canada, the EU, China. They in turn are putting tariffs on us. We in turn are putting reciprocal tariffs back on them, right? You've got a tariff/trade war happening in full swing. 10 seconds or less. How does this end and who wins? Go.
It's not clear how it ends, but certainly there's likelihood that both sides back down some. They'll have to negotiate the settlement. And at the end of the day, I'm sure tariffs will still be higher. And so we'll have some inflationary impact from it.
Okay, let's expand on that a little bit. Who gets hurt in that environment? Is it the person who's putting an addition on their bathroom and uses Canadian lumber that just got more expensive for them? And that's just the way it ends? As a result of that, just the average American consumer pays more for certain things?
Absolutely. And the average consumer is going to end up paying more because tariffs are higher. And at some point in some places, and that means that those goods and services cost more. So, yes, that takes a bite out of consumer budgets.
Okay. And with that, maybe then you've seen the market get more volatile, though, right? The market has come down a decent amount over the past 2 weeks related to tariffs. I guess if people have less money to spend because of additional costs, you're seeing that happen. As a result of that, you would think that investors move from equities to bonds, right? And therefore yields come down. So by doing this, is the administration doing the Fed's job for them? By scaring people out of the equity market or getting the equity market to roll over, are they doing the Fed's job without the Fed having to cut rates? Go.
I want as much time to answer the question as you took
Go.
to ask it.
You can take more than 10 on this one. For the first time ever, you can break through the 10. Go.
So, first of all, the reason the market has come down is because of higher tariffs, and that's causing people to worry about a recession. And that's why rates have come down. People have sold some stocks, bought some bonds. That's pushed bond markets up, and they've pushed stocks down. But they're pricing in the risk of a recession, which is not the first time it's happened. We saw it when we had an inverted yield curve. It didn't happen then. I don't think it's going to happen now. It'll take something off the growth rate. Growth will be a little bit weaker as a result of the tariffs, but I don't think a recession is on the horizon.
All right. What about now we'll go back to 10 seconds, geographically specific recession? And I'm talking about Washington, D.C., right? Which is going to be pulverized as a result of job losses, right? Everything from what, DOGE is doing to companies that had, consultants that would call on these people who now don't have jobs, right? So the ramifications go well beyond just government employees who are going to be laid off. With that, I'm sure you're going to have every small business in the DC area impacted: restaurants, clothing, retail, housing, all of that kind of stuff. Is what DOGE is doing going to be effective? How much money do they need to have saved in order to make this sort of experiment worthwhile?
That's a good question. So the fact of the matter is, when you add up Social Security, Medicare, defense, and the interest bill, you're talking about 85% of total government outlays. So there's only 15% left to cut. And therefore, and it's not going to zero. So it's unlikely you're going to have a dramatic effect on the government budget because of DOGE. You've got to get stuff that's off the table on the table, and our politicians really don't have an appetite to do that.
So when we may end up going over 5 questions, what's the point then of what they're doing?
Well, at the margin, it sends a message They have to, there's no one who thinks that the government is efficient. There's lots to be gained by improving government efficiency. I think the effort to reduce regulation is really potentially very powerful because that's a real inhibition to growth on the part of American companies. So that would be a big plus. But the fact of the matter is, if you really want to reduce the deficit, and that's ultimately necessary, you've got to look at the big items.
Okay. Where do you think the Fed is through the remainder of the year? Right, inflation seems to be coming down. But where do you think the Fed is for the rest of the year? And does it have the same impact because yields have already moved down? Go.
Yeah, because yields have come down, it reduces the need for Fed ease, and it's not clear there is a need for Fed ease. A slower growth rate is really necessary because the labor market's already tight. We can't grow at 3%. We can't even grow at 2.5%. So if we come down in the ballpark of 1.5% to 2%, that would actually be very helpful. It would certainly it would help keep inflation pressures from increasing. I don't think it reduces them. So right now, I think the Fed's on hold, and it'll wait to see how things play out.
Last question. 10 seconds or less. This one, we're going to force you to stay to 10 seconds. Was the market drawdown that we saw, this 10% move or whatever it was, the right reaction percentage-wise to the drama, the tariffs, DOGE, all these headlines, all this kind of stuff? I mean, we had back-to-back 20% years. Obviously, that's not, it's very hard to do that a third time. Is this a normal reaction, an overreaction, or is there more pain to come?
In my judgment, it was a normal overreaction. I don't think the economy is going to really be hurt that badly. So the stock pullback is a little bit excessive in my mind, but it's typical. It's a stock market. It tends to react very strongly both to the upside and the downside. So absolutely normal.
Absolutely normal. 10% draws are normal, happen like once a year. So here we are.
Right.
With that 10-second interview show, like and subscribe, like and subscribe, like and subscribe. He's Chuck Lieberman. I'm Mike Lieberman. Yes, we are related. Until next time.